Good morning, everybody. Hey, welcome to the second unofficial start or end of summer. It's Labor Day weekend. Hope everybody has a great Labor Day weekend with their friends and family. I hope everybody's safe this weekend if you're traveling. Today, I just wanted to kind of go through. Last week, we sent a little video out of some of the charts we've gone through. Today, I want to go through just a bit of the newsletter we're going to be sending out. The thematic part of this newsletter is the Titanic. So want to go through just a bit of that, if you will. So we're going to share just a bit of that newsletter, and we'll back up to a front part of it. So the pictures up here are pretty interesting. Everybody thought that was going to be the unsinkable ship. Took off. Everybody's very, very happy. That is where the ship lays currently at the bottom of the Atlantic Ocean. So all those hopes and dreams and the tragedy of the death and destruction, obviously insurmountable, but that was the unsinkable ship. So feel free to read through the newsletter and find that. On the chart side, I just wanted to kind of share a couple of the charts. There's a couple of things in here from Bob Farrell. Just some rules to think when we're looking at all these overvaluations. The market is extremely overvalued by any historic measurement. So as you know, we've been kind of reducing risk over the last few years, kind of running into this what looks like it's maybe a market top in here. Who knows how far it'll go? Sometimes markets can stay overvalued longer than you can be patient. That is absolutely true. A couple of these charts, things that we should be concerned about in here, I would suggest, is the extreme overvaluation in here. Let's do some doodling here, which I love to do. Overvaluations in here. This is 1929. This is going into the 65. Although we made no money. I think that was in a chart last week. Markets didn't make any money until 1983 there. This is 2000. Markets were extremely overvalued in this period of time. And here we are at 76. This is just the amount of stocks concentrated in the S&P. That's all the artificial intelligence stocks, NVIDIA, Facebook, Tesla, Netflix, all the top 10 stocks. Again, so this is 76, 75% in 1929. Net seeing the peaks even in the dot-com bubble that burst. Now we're 76% in terms of concentration risk in the largest companies in the S&P. I mean, what could go wrong? I hope nothing goes wrong for all of us, but it's time to pay attention and to be careful. So let's go in here. Another way of looking at this, same kind of chart in here. This is kind of the returns after we hit these peaks. You know, once those stocks start to kind of falter, we see these large forward returns in the markets are actually very, very kind of negative. It's not the end of the world. You have a long-term objective, but how long is long-term? Most of it's like 3 months as a long-term investment these days. So, you know, it's time to pay attention. That's all I can really suggest. Another way of looking at this is a nice chart from Hussman Strategic Advisors, just in terms of a different way of looking at the numbers. Again, this is the 20s. This is where we are now. So we are all into the stock market, and it's not a bank account that earns, you know, X percent, 9, 10, whatever people want. It is an investment account that has risks. The markets have risks that I don't think people are ready for on the downside. So please read through the newsletter and check out the comments that we've added to the context of the charts. The reason I like showing charts, and I know it looks like an EKG, you know, could look like a bad heart attack or something like that. Try to be visual. I'm a visual learner, so I think the charts are important. If we can draw a picture of what's going on, I think it's really way too important. Last thing, you know, everybody's waiting for this yield curve. I think, hey, Trump or Scott Bessent at the Treasury and the Federal Reserve, we're all going to cut rates based on what Jay Powell said last week. I think it was last Friday at Jackson Hole. This is what happened when they cut rates last year. So this is the interest rate. This is the where they cut rates. Now rates actually went up. Fed funds went down, but rates went up. So just because they cut rates does not mean that overall bond rates are going to come down. And that could be something where you want to buy a 10-year US Treasury and look at the risk. We're going to buy a 10-year Treasury for 3%. And inflation's running 5 or 4, depending on how you count. And ask anybody to go buy an air conditioning system in Fresno this summer. It's $14,000, and 7, 8 years ago it was $7,000. So there's certainly some inflation out there that's not really counted correctly in that. Anyway, you guys all have a great weekend. I hope everybody has a long, nice holiday week, the unofficial start of summer. number two starts today. School starting last 2 weeks ago, and we have till September 21st to have the official end of summer. But hey, Starbucks has the pumpkin spice lattes out now, so I guess it is actually fall. But anyway, hey, you guys all have a great weekend, and if you have questions, please reach out and call me or Vance or Jeanette. Thanks so much, and have a great weekend.